Good morning, everyone. Welcome to the fourth event in our series of affordable housing virtual forums. And thank you, everyone, and all of you for being able to join us today. In particular, I'd like to thank some of the elected officials that we know have been able to join us today. First of all, I'll name some of the county councillors for County of Simcoe. We have Deputy Mayor Anita Dubois in the town of Penetanguishene. We have Mayor Doug Leroux from the town of Penetanguishene, and we have Mayor Floyd Pinto from the township of Agila Tazarantio. We also have a couple members of our Affordable Housing Advisory Committee present with us today. We have Councillor Anne-Marie Kungle from the City of Barrie. We have Councillor Jay Follis from the City of Orillia. And then in addition to that, we have a variety of councillors from our local municipalities. Welcome to Councillor Jill Saint-Amand from the town of Penetanguishene, Councillor John Main from the town of Midland, Councillor Judith Cox from the township of Severn, and Councillor Mary Warnock from the township of Tay. So in today's session, we will be exploring funding and financing for affordable housing creation with a number of experienced guest speakers. We have Howie Wong, who is the CEO of Housing Services Corporation, who will present on financing opportunities for nonprofits. We have Vesna Spehar, who's the account manager in the multi-unit residential client relations portion of Canada Mortgage and Housing Corporation, and she will present on mortgage loan insurance. And finally, we have Arlene Etchen, also from Cmhc, a regional consultant, who will present on the National Housing Strategy funding and financing opportunities for private and nonprofit sectors. My name is Arvona Zwiers, and I'm the Director of Social Housing at the County of Simcoe, and I'm proud to lead this great team who's putting together this virtual forum. So just a few housekeeping notes, as always. Today's session is being recorded and will be made available on the county's website at www.simcoe.ca/our-AHHPS. During the presentation, please feel free to use the question and answer box on the right of your screen in order to submit a question to our team. Now, due to the size of the group, and we are at over 70 registrants for today, similar numbers to the numbers that we've had before. Due to the size of the group, the moderator will likely group the questions according to theme. And for any questions that we're not able to answer at this point in time, staff will reach out further and follow up with an email response. Our first speaker today will be Chief Executive Officer of Housing Services Corporation since 2013, and that is Howie Wong. He is also on the board of several financial service organizations that are dedicated to the cause of creating affordable housing all across Canada. And Howie was also General Counsel and Corporate Secretary of Toronto Community Housing Corporation, Canada's largest affordable housing provider. Please join me in welcoming Howie Wong. Howie, over to you.
Thanks very much, Arvona. I really appreciate the introduction. I'm delighted to be here and to talk about financing affordable housing. On my first page, I thought I would, before I jump into the notion of financing, give you a bit of a one-page introduction to Housing Service Corporation, or HSC. I'm sure that we're familiar to many of those out there who are nonprofits. HSC basically is a fairly new organization, and we were established by the province back in early 2000 when housing was downloaded to the municipalities or service managers. And so we see as our clients the 1,400 plus providers across Ontario and the 47 municipal service managers. We don't receive any funding from any level of government. We charge a small markup on all the services, and we are a nonprofit. As Arvona mentioned, we provide some really important services to nonprofit providers across Ontario. For one thing, we are an insurance broker. We insure over $28 billion of assets for 600 plus providers across Ontario. And secondly, we're an energy company. We purchase energy right from the wellhead in Alberta, bring across the pipes and distribute across Ontario. Through our subsidiary in CASA, we are also a registered mutual fund manager. We manage over $500 million of capital assets for providers in Ontario. And lastly, we are very heavily involved in providing consulting services, what I call the McKinsey of the community housing, where we provide strategic advice, asset management advice to providers and service managers across Ontario. And we also have staff, engineers on staff who will help providers in terms of implementing regeneration projects, sort of the owner's advocate. Now, on to financing. Next page, please. In a typical housing financing, when you're building affordable housing, you're basically building a 40 plus year asset. And the challenge for us in the nonprofit sector is that we basically have access to really poor financing tools. We basically are getting access to 5- and 7-year mortgages effectively. And when you're financing a 40-year long life asset with 5-year mortgages, you're going to refinance that project 6-7 times during the course of life cycle. And every time you refinance, you're subject to huge interest rate risk. And so, you know, if rates, when you refinance, say in 5 years out, go up by 2 or 3%, then your project is going to blow up. You just don't have the ability or the room to accommodate that kind of huge increase in the interest rate. And what happens is that, you know, affordable housing development is tough enough as it is, but if you're going to refinance it, you know, 5-6 times during the course of life cycle, then you've become, in addition to that, an interest rate speculator, and that's not something that's acceptable really in affordable housing. And so, what we have been looking at is whether we can basically provide a 40-year mortgage to you. And if you have a 40-year mortgage, fixed rate, then you have de-risked your project. And basically you have a financing tool now that matches the life cycle of your asset. And this is not a new idea. This is something that's been done in many of the power utility companies, where, for example, Brookfield. You know, Brookfield would never ever build a 40+ year asset without having a matching financing tool. They would never build it with a 5-year mortgage, and that's basically the idea here. Is that we're looking to offer up 30, 40-year fixed rate mortgages for the sector. The next slide, please. And the notion of creating a 40-year mortgage really came about through a group called the Housing Partnership Canada, HPC. Basically a group of CEOs and nonprofits. We meet about 2-3 times a year, and I guess a couple of years ago, perhaps after too much dinner and wine, we decided to address the real tough problem of lack of access to long-term financing for affordable housing. And so we passed around a hat, collected some money, and we engaged an investment banker in Bay Street to look at the possibility of building this kind of what I call a sector bank. Next slide, please. So what we have in front of us is basically the creation of that bank, and it's called HBC Housing Investment Corporation, or HIC for short. And the 3 founding members are my organization, HSC, BC Housing, and Manitoba Housing. And these 3 founding partners have contributed money to HIC. And, you know, this is a Canadian platform. It's not just for Ontario. Ontario alone would not have enough, I think, capacity to really support HIC. So we've gone basically on a pan-Canadian sector bank. In Ontario, we have over 250,000 units, but pan-Canada is over 650,000 units. And then we have also looked to our Cmhc partners, and that in terms of funding too. And that leads me to the next slide. And so the 3 founding partners have contributed $3.5 million, BC Housing, Manitoba Housing, HSC, as basically startup capital to build the platform for HIC. And then through our partners at Cmhc, through the Innovation Fund, this was a fund that was announced several years ago for $200 million. They dedicated 10%, $20 million of that innovation fund to us to act as a credit enhancement. So that if there are any losses in High C, then it basically would be dealt with through the $20 million. And with this capital, the $3.5 million and the $20 million Cmhc, we have the ability to access $400 million in the capital markets. And so this really, if you're a retail borrower, you're basically dealing with the banks and the credit unions. In the instance of finding 40-year money, you basically have to go to the capital markets. This is the capital markets in Canada, basically the pension funds, the life co companies who are looking to place 30 and 40-year bond money. And these are basically at wholesale rates. And these capital markets are exactly where the banks and all the big public companies are seeking to also seek the money. The Brookfields would never fund these long-term assets through the banks. They get it through the capital markets. And that's basically where we would go. So High C basically accesses the money in the capital markets, borrows 30-40-year money, and then on loans it to providers with a very, very small markup of 15 basis points, 0.15 to cover our admin fees. And because we are accessing the markets, the capital markets, we also need a credit rating. So we are also rated by Standard & Poor's, S&P, and we've received a phenomenal rating of A low, which is actually better than many charter banks. Laurentian Bank is a BBB. It speaks to the quality of the structure that we have at High C and the quality of our sector, because we will only loan to nonprofits for affordable housing. Next slide, please. So you probably remember the first slide I showed where we had that little goldfish up against the sharks. Well, with this High C model, we are basically using the power of the group to take on the financing. We have the ability because of the aggregation. You don't need, for example, normally you need a minimum $40 million to borrow in the capital markets, but because we're aggregating projects, so we go across Canada and find $1, $2, and $5 and $10 million projects. Once you get to a critical mass of 40, then we go to the capital markets, borrow that money, and on loan it to providers. And so in our structure, we're happy with a $1 or $2 million loan. It's all about aggregation, using the power group to give you access to wholesale rates, long-term capital market bond money. And right now, if we were to close a deal, the rates for a 40-year mortgage would be about 4% all in for 40 years. And because of our size, because of our we negotiate directly with the life co companies and the pension funds to get the very best terms and rates. And so now we actually have the ability to negotiate on an even keel with the bond market and the capital markets for the very best rates. Next slide, please. And so we did our first pilot round in February of 2019. And we issued a bit over $30 million of bonds, and we highly successful. Canada Life loved the new asset class that we created in affordable housing, and purchased 100% of all our bonds. And so with this new pilot round, we funded two projects. One at the top right there is the Capital Region Housing Project, the largest nonprofit provider in Edmonton. And that is a two-building multi-res called Parkdale. And we provided $10 million at 30-year mortgage for 4.26. And then the second project we funded on our first pilot round is the Community Land Trust. It's the lower picture there. It's a gorgeous building on the former Olympic site, and it's on 60-year lease land from the city of Vancouver. And so we provide $20 million of 40-year mortgage money at 4.415, and that basically allowed the Community Land Trust to prepay the city of Vancouver $20 million on their 60-year lease. And these projects are fabulous because they are mixed rents, and so they have deep affordable rents, RGI, affordable, and some market. Most of these buildings, by and large, are about 20% market, and that range of rents allows these projects to be sustainable going forward without any government subsidy whatsoever. These projects are fully sustainable, and they even have the ability to set aside 4% for capital reserves going forward. So these are the kinds of projects that we are really interested in looking at, and I think this is the future for our sector, so that projects are sustainable. Of course, these projects required a fair bit of government grant money, but all that was put up front to really reduce the overall need for lending. And we encourage these two projects to really push all the government lending grants on the front end, reduce the actual loan that's required in a takeout. And as I said, these are fully sustainable projects on their own. They all have NOI and debt service at 1.1. So these are the kind of projects we're very, very interested in looking at. Next slide. And after we closed that pilot round, a lot of interest from many levels of government in the newspaper. And so this is what I call our self-promotion slide, where we have all these quotes lauding what we're doing. Next slide. So what I just talked about in terms of our February pilot round was basically takeout money. These are projects that had already been completed, and we are just going in to provide takeout financing for 30 and 40 years. What we are developing right now is actually a new loan product, a blended construction loan with a takeout. In our sector, unlike the private sector, we, when you build, and you're constructing a project, it's usually interest only, variable rate. And then in 2-3 years out, when the building is completed, then you have a takeout. The challenge there is that on takeout in 2-3 years out, you'll be subject to interest rate risk, because you don't know what the rates will be at that point in time. And in our sector, there's no need for that. And so what we've developed is a blended construction financing takeout. So for example, on a 40-year mortgage, we would provide you with 3 years of interest only, so you can build the project. And then once you're completed, it automatically converts into a takeout. The beauty of this is that you'll know your interest rate right from day one when you put the shovel in the ground. So you basically de-risk your project on takeout. And as I said, we are developing this brand new product because it's heavily needed and is seriously needed in our sector. And we're hopeful that we'll be able to provide the first pilot loan later this year on the blended construction takeout financing. Next slide. So in terms of our loan program, we're looking to get up to about $300 million this year. We have a number of blended construction takeout loans right now that we're looking at across Canada, and we're continuing to offer up. And what we've recently just approved at the board of High C is a social bond structure. Because there is so much interest in capital markets, in impact in investments, ESG, environmental, social governance investments, we in the affordable housing sector are just perfect. Many life co companies and pension funds are looking to invest in social impact bonds. And so we've actually just announced very recently that all our bonds going forward will be social bonds in compliance with all the regulatory requirements. And because of this, we also have the ability to really drive down the cost. Because there are not many vehicles or opportunities for social bonds, there is a huge demand for it. And so that really helps us to control our costs and the ultimate cost of money to the affordable housing sector. So once we get past these construction takeouts, we're also looking at regeneration, probably in the next year or two, and also conversions. I know there's a lot of interest in converting multi-res properties into affordable housing. So these are things that are on the horizon in the medium term. So things that we are looking at, and they should be looking out for. And that's it. That's my presentation. Let me pass it back to John for Q&A. Thanks for the opportunity to speak.
Thank you, Howie, and good morning, everyone. My name is John Connell. I work in the social housing department at the county, and just be taking you through the Q&A session. So happy Thursday. That was a lot of great information and innovation there, Howie. As Arvona had said at the start, if you wish to ask questions, then please type them into the box with the question mark in it, and then we can deal with them. So, okay, we do have a few come in, so I've published them. Can you see those questions, Howie, in the Q&A box?
Not yet.
There's one that says, can you please post the link? Okay, that's for us, where the video will be. Yes, we will do that. It will be on the county's website, but we will post the link before the end of the session. And then there's a question here. Have you discussed grant contribution potential with Cmhc co-investment? Is there a way to stack Cmhc co-investment contribution with a high C loan?
We had discussion with Cmhc on that. The challenge with the co-investment and combining with stacking the high C is that both requires a first mortgage. We require a first mortgage on our loans, and so does the co-investment fund. There might be an opportunity to share that first mortgage, but we haven't taken that path yet. But we're happy to consider it if that is of interest to providers.
Okay. When you were mentioning Howie, well, obviously High C is focused on non-profits. Can you tell us a bit about some of the lending criteria that you have in terms of, you know, how you approve projects and borrowers?
Sure, happy to. We have a pretty good site for housing for High C, and I'll flip you the site, John, to share with people. But we actually have on there some pretty good outline of our lending criteria, how we approach loans, and basically we're like any other lender. We are a cash flow lender. We're very focused on debt service coverage, and so our minimum debt service coverage is 1.1. Two is that we're also very flexible on loan to value. So we'll loan up to 100% of loan to value, because we recognize that at the end of the day, it's all about cash flow. And so, as I said in the presentation, we are very interested in fully sustainable projects. 100% RGI is challenging for us because there's a need for a government subsidy in it. And if we were to offer up a 40-year mortgage, then we would need some certainty on the 40-year government subsidy, which is not really, feasible. And so we are looking at some projects which are heavily subsidized, RGI equivalents to us in Ontario, but government is backstopping that effectively. And so that's the approach that we take. At the end of the day, we are a nonprofit. We charge a very small mark of 0.15, but we still are a lender. And so we are very rigorous in our approach. We lean heavily on the BC Housing underwriting criteria. BC Housing lends over close to $3 billion on right now. The loan book's close to $3 billion, so they have very robust underwriting standard. They are a national housing lender, and so we basically lean on their underwriting people and standards to underwrite projects for us. At the end of the day, the money has to be paid back to our bondholders, and so that's really important to us. The beauty of our sector is that, when we presented our project to the capital markets, our dealers, our underwriters are TD and Scotia. We could not find one project anywhere in Canada in affordable housing where a lender has lost $1. Sure, there are projects that might encounter difficulty or from any point in time, but what happens is that all the stakeholders, the service managers, the province, all the levels of government roll their sleeves, go in there and fix the problem, so a lender never loses a dollar. And I think that really speaks to the quality of our sector and why there's such a strong interest from the capital markets in investing in affordable housing in Canada.
Thank you. You were also talking about the new blended construction takeout financing, and I think I heard you say that so the construction financing is interest only. What sort? I know you haven't actually issued this new financing mechanism yet, but do you know the sort of range of the interest rate during construction?
Because we're borrowing the money directly from the bond markets, the interest rate during construction will be exactly the same during the entire term. So, for example, if the rates today are about 4%, if you were to close a deal today, we'd be about, say, 4%. And so during the construction only period, it would be 4% interest only. And then, so if a 40-year mortgage, 40-year 4%, and then the 37 years balance would be the principal and interest blended. And so that's how we structured it at this point in time. But again, as I said, the beauty of this long-term financing that includes construction and takeout is that you don't have that interest rate adjustment on the takeout, which is the scary part. The rates are going up right now. I've been watching the 30-year bond rate, which is basically what is a bit of the proxy for our mortgages, and they've gone up by over 0.5 percentage point in the last 4 weeks. And projections are that those rates, which are now about 1.8 for a 30-year bond, will probably be about 2.5–3% this time next year. And so rates are going up. And so I think there's a window of opportunity for us in our sector to lock in long-term rates before they go sky high. I remember when I was, just getting out of school, looking at my first house purchase, rates were 12% and up. And I think, I'm not sure if those rates will ever come back, but I think our low interest rate environment has spoiled people. They think these will exist forever. I don't think that's the case. So I think that, as I've been telling people, borrow as much you can for as long as you can right now. Now is the time.
So we have had some more questions come in. Can you see them in the Q&A?
Let me just see.
I think the one we'd start with is, would high C takeout financing be applicable to supportive housing projects? Can you see that question?
We're happy to look at supportive housing.
Yep.
It all depends on the pro formas and the financial model. We'd have to look at the the NOI, the net operating income on the project, and where the income would come from. If there is ongoing government subsidies there, we'd have to look at the stability of that. As I said, in a 40-year mortgage, our bondholders will say, well, how stable is that government subsidy? So we'd have to look at all of that as part of it. But we are definitely very interested in nonprofits and supportive housing.
Okay. Next one here is, have you contemplated land acquisitions through high C loans, i.e. interest only or capitalized interest for pre-construction prior to construction loan?
It's tough to basically create I guess it's equivalent to a land trust, because there has to be income generation on those land acquisitions to support our loans. So we'd have to say, well, how do you support the loans? Are there other projects that might be in your portfolio that would support it? But then we'd have to take first mortgages and all of that. It's just it's a bit more challenging, but it's not. I'm not saying no to any of that. We haven't done it yet, but again, if we're quite happy to look at it. High C was created out of a vision to support the nonprofit sector across Canada. And if we need to look at things differently, we will do that. We have been very nimble in our approach. For example, in the normal scheme of things, we can probably turn around views within a month, a couple of weeks after we get engaged as to whether the project works or not. We actually have templates online, so you can actually self-evaluate, what will work for us or not. So we're quite happy to look at anything at this point in time.
Okay.
I see a question. What do you define as affordable? We're very flexible in our definition of affordable. We will basically rely on the municipality's definition of affordable. Because we are loaning to only nonprofits or organizations controlled by nonprofits, we are very reliant on the mission-driven aspects of these nonprofits, that they will do all they can to provide as much affordable housing as possible. And then we will then look to the municipality for their definition. So some municipalities are quite flexible, and we're quite happy with that. So we are quite broad in our approach to the definition of affordable.
The next one.
If an NGA took out a loan, how long do you expect to pay back? Again, it's 30, 40-year mortgages. For Takeout, it's standard principal and interest only. If you're interested, the first step is to go on our website. All our contact information is there. We also have a Q&A section, and we're happy to just send us information. The first step usually is just send us a project profile and your pro formas, and then we'll put it into our templates and then run it through it, and then tell you what we think. And we spend a lot of time with providers because we'll make suggestions on the pro formas. Can you do this? Can you do this? Can you do this? Because we're here to help you. We don't need you to have a fully baked cake. We're happy to work with you in baking that cake for a project. The next question, can a provider currently Cmhc insured refinance through High C upon a renewal? At this point, because we have capital from the Innovation Fund, we can only fund new affordable housing stock. So at the present time, we are restricted from refinancing current buildings. This is only for new builds, but I'm hopeful that in the midterm, we will be able to expand out. Because I think there's this is a classic case where if we can refinance, it's actually a much better risk, because a building is already occupied, fully rented out is a much better risk for us than a new build where you have a long stabilization period to get to full rental. So at risk level, current builds are actually better for us. We just don't have the ability to do it yet. But as I said, that's a midterm objective for us.
Okay. There's another question coming in. Oh, it's just a thank you. So yeah, thanks, Jay. Okay, well, we thank you very much, Howie. That's great. There will still be, if you have further questions you think of for Howie, you can type them into the Q&A, and we will try and get back to them time permitting with this morning's presentation, because we do still have another hour. So the next part of the morning is we're going to have people from Canada Mortgage and Housing Corporation sharing with us. And first up, we have Vesna Spehar, and Vesna's an account manager with multi-unit client relations at Canada Mortgage and Housing Corporation. And Vesna is going to be sharing with us facets of the Cmhc mortgage loan insurance products. So good morning, Vesna, welcome, and over to you.
Good morning. Good morning, everyone. Sorry for the delay here. I am happy to be here with you and share some of the information from Cmhc. Thank you to County of Simcoe and your guests. Thank you for inviting me and your guests for being part of the presentation and listening. So I'm just getting my presentation on. Can you please let me know when it is visible? And I will start. Are you able to see it?
I can see it, Vesna.
Perfect. How's
yes,
the excellent? How's the audio? Am I loud enough? Is it clear?
Yes, it is.
Okay, perfect. Thank you. So Hello, good morning, everyone. Today I will be speaking to Cmhc loan insurance products, and I don't have a whole lot of time, so I will be getting the presentation on shortly. So, why do we focus on the rental? Canada is in the top 10 of the developed world countries, with 66, close to 67% of home ownership rates. There are still over 30% of Canadians who rely on rental housing as an alternative home ownership. So, it is continued access to both affordable and market rental housing is critical for about a third or so Canadians. A little slight delay in moving the slides forward. What is mortgage loan insurance? So just quickly around a little bit about mortgage loan insurance. I'm sure a lot of you are familiar with it, but just a reminder that it is protecting lenders against the losses arising from mortgage loan default. So generally speaking, for homeowner mortgages, which is 1 to 4 unit property, it is required if the borrower has less than 20% down payment, and the maximum loan to value is 95%. But unlike the homeowner mortgage loan insurance, insuring multi-unit properties, so when I speak to multi-unit properties, I mean 5+ units, residential loan for the multi-unit is not requirement. So multi-unit loans are insurable at 85% loan to value. So what are the advantages for the borrowers? Why should someone pay premium and insure their mortgage? What do they get from insuring the mortgage? They can obtain mortgage financing with a higher loan to value. Our standard loan to values are 85% for purchase or refinance. On a construction financing, it's 100% loan to cost or 85% loan to value, whichever is less. So it's giving them access to higher loans. Also, the longer amortizations, which is up to 40 years, are reducing the mortgage payments and then increasing cash flow as a result. Lower interest rates. The borrowers definitely benefit from having insured mortgage because the interest rates that are offered on insured mortgages are lower than uninsured mortgages. On average, we're seeing about 0.8 to 1% lower interest rates on insured mortgages than uninsured. And a reduced renewal risk. Well, this is not something that is that important in good economic times, but it comes evident when the economic times aren't as good, because once insured mortgage, it stays insured for the remainder of the amortization unless refinanced. And at the renewal time, the borrowers also have availability to access lower interest rates, as well as almost guaranteed renewals, because the lenders are willing to transfer the mortgages, sign the mortgages, or renew them, knowing that they're fully protected against the default. Next slide, please. I'm just going to touch briefly on transaction types and shelter models. Don't have enough time to go into all of them. In the next slide, please. So I will be talking, when we talk about transaction types, new construction, we do have draws for new construction, as well as a takeout financing, purchase of existing properties, refinance. This is a purchase or refinance with improvement as well. In terms of refinance, I just want to mention that as of May of this year, we have introduced a new policy, and there are some restrictions in terms of the use of the funds. And the funds are allowable uses, and this is as of May of 2020. Allowable uses are purchase or construction of another rental property, repairs and capital improvements to subject property or another rental property in the portfolio. So we basically eliminated equity takeout out of the refinance use of the funds. And the goal is to promote new rental stock or improve and preserve the existing rental stock. Next slide, please. In terms of shelter types, as you can see on the screen, we have we do support pretty much all of the residential multi-unit family rental types. Standard rental housing is your cookie cutter apartment building, 5+ units. And just to mention that we allow commercial component in all of our shelter types. However, that commercial component cannot exceed 30% of the overall footage of the building or property. Student housing, we do allow purpose-built student rentals. We have a specific product for that on or off campus, and the student housing rent is usually charged per room. Single room occupancy, this is a shelter type that we don't see as often. It is, you know, they usually are rented by rooms, or they are rented by rooms, single room occupancy. They share common areas such as kitchens and bathrooms, may have bathrooms shared by several rooms, or some have even in the room, but typically they would share kitchen. And rent, as I said, is charged per room. Retirement housing, I do get this question a lot, especially lately. Do we finance retirement housing? And yes, we do. Retirement housing has a little bit different feel and look to it, the retirement housing product. We do require minimum to have, for the project, to have 50 beds or 50 units. And, you know, some certain requirements around specific to shelters. So, for example, 75% of the units have to be single room occupancy, and some other requirements. But as I said, that is going too much into the details, not enough time in this presentation. Supportive housing is also one of the shelter types that is supported or provided, product is provided for. These shelters provide short or long-term housing options, usually as a traditional stay, while the tenants are getting back on their feet and can get reintegrated back in society. So here you would usually have various shelter types, such as youth and women shelter types. So these are the 5 types. If we can, and Cmhc also promotes green housing and energy saving housing solutions. We do provide premium refunds for energy efficient housing on all of the shelters, including the affordable programs, which I'm going to be speaking to on my next slide. So please, next slide, please. As I said, we do offer qualifying projects additional flexibility for the creation of the affordable housing units, and premium refunds are applicable on those as well for the energy efficiency. So they're typically, you know, when we talk about affordable housing and the affordability criteria for the multi-unit insured product, we do have 2 types of the criteria, 2 sets of the criteria. One is for new construction, one is for the existing affordable projects. For the new construction, under criteria A, 10% of the overall rental income has to be lower than potential. Sorry, the residential income has to be 10% lower than potential residential income for that property in that market, plus minimum 20% of units have to be affordable. And the receiving, or under the option B, the property should be receiving support from another government program. It will qualify for our affordable mortgage loan insured product. For existing properties, the criteria is slightly different. Under the option A, 80% of units must be at or below the 30th rent percentile for that market. But the option B is same as for the new construction, where the project should be receiving support from another government program. Next slide, please. So expand on criteria A, discounted rents. It is important to understand that the affordability criteria is flexible, as it allows the builder or the developer the ability to identify how they want to distribute or the reduced rents within their project. So here is an example that you see visually. Builders will have an option to discount all of the rents by 10%, and that's effectively achieving that 100% of units are at 90% of potential rental income. Or they have an option to the graph in the middle, that 20% of units are discounted by 50%. So again, they achieve overall 10% reduction on the entire building. Or the option 3, for example, where half of the units are at 80% of the potential residential rental income. So the bottom line is that flexibility is given to builders to distribute the rents over as many units or as deep as they want to go with a discount as it fits or it suits their project. Next slide, please. Sorry, Brittany, can we move it to next slide? What are the project size and project types? So again, a minimum is 5 units, except for retirement homes where we have 50 beds. Other than that, all of the shelters pretty much apply except for purpose-built student housing. So that's standard apartment, retirement homes, single room occupancy, and supportive housing projects. Next slide, please. Eligible borrowers, a wide variety of the borrowers, public sector, borrowers within public sector, within private sector, and nonprofit organizations are all eligible borrowers. Next slide. In terms of specifics and what else is advantageous for affordable housing multi-unit mortgage loan insured product, we go a little bit higher. We allow a little bit higher loan amounts. So for the new construction, the maximum loan amount can be up to 95% loan to cost. This sometimes translates into over 100% loan to value. On the non-residential space, I mentioned that commercial space that we allow the 30% maximum of the gross floor area. We do, however, limit that lending to 75% loan to cost. When we talk about existing properties, we switch the measuring or assessing the loan based on loan to value. So for existing properties, 85% loan to value is maximum loan amount and 75% loan to value for non-residential space. The debt coverage ratio is reduced. It's lower than for the rest of our products. It is down to 1.1, same for existing or new construction. And other shelter models, so for example, retirement homes or standard apartment style, the debt coverage ratio would be 1.4. For affordables is 1.2, and same for the supportive housing and single room occupancy. Non-residential space, we still underwrite as 1.4 debt coverage ratio, no change from standard rental apartment. That is the same. And next slide, I believe. So this is my second last slide. Amortizations for the flex product or the affordable is 40 years. It's a standard for all of the project types and shelter types. And one big advantage of having the flex loan or affordable loan is that on the construction side is that full loan is available once construction is complete. So there is no rental holdback achievement. When the construction is done, you get your last advance and the financing is complete, as opposed to standard rental market where there might be a rental holdback achievement. That final loan advance on a construction project will be made only once when the property is fully leased up or effective gross income is met. So that's one of the advantages of having an affordable product insured. Again, the full financing available once when the construction is complete. And that's it. Next slide, please. This is just giving you the information or link where you can find a lot of information on multi-unit residential lending, including a reference guide, which has a lot of these fact sheets that I have talked about regarding shelter and transaction types. Really good resource, as well as some other resources. And that's the end of my presentation. I will take a question after Arlene finishes her presentation, which actually leads me to introduce my colleague, Arlene. And she will be having presentation, and she'll speak to National Housing Strategy funding and financing opportunities. Thank you again to County of Simcoe, and Arlene, over to you.
Great. Okay, thanks, Vesna, and good morning, everyone. I'm pleased to be here on behalf of Canada Mortgage and Housing Corporation. So Vesna gave a great overview about how our mortgage loan products work in creating housing. And so, as she said, I'm going to provide an overview of the available funding programs under the NHS, how they work, who's eligible, what kind of projects are eligible, and I'll also share some examples of projects developed under the NHS programs. So let me just call up my presentation. And there we go. It should be live now. Great. Okay. So as background, the National Housing Strategy was announced in 2017 and is a 10-year, $70 billion program. So we still got a few more years in this NHS environment. And really, it was designed to fuel the economy and also give Canadians across the country a place to call home. So there's 4 key areas for funding. So the creation of new housing supply, the modernization of existing housing supply, resources for community housing providers, and innovation and research. Now, of course, there's also other initiatives under the NHS, but for the purposes of today, I'm really going to focus on the funds for new housing supply. So the NHS started with a vision for inclusion housing, and so it goes beyond just a roof over our heads and has 3 key principles: people, communities, and partnerships. So from a people perspective, the funds are going to focus on the needs of vulnerable Canadians, and that includes seniors, women and children fleeing violence, Indigenous people, persons with disability, those with mental health and addiction issues, veterans, and young adults. From a community perspective, it'll create a new generation of housing that promotes diversity and inclusion, and is a catalyst for more sustainable, accessible, mixed income and mixed use communities. And you'll see this as I go through the funds. There's requirements for things like accessibility to be built in, energy efficiency to be built in, and the projects we fund are really multi-unit projects. And finally, partnerships. The NHS will create more opportunities for greater innovation and collaboration amongst all levels of government, nonprofit, cooperative housing providers, the private sector, and even academia when we're talking about our research to make a difference in the lives of Canadians. So here is an overview of the CMHC product offerings that we have, and they go all the way from pre-development to rent up and stabilization. So we have our seed funding for soft costs, and I'm going to talk about that in a little bit more depth. We have our co-investment fund, which is our flagship fund, which is low-cost loans and financial contributions. The Innovation Fund, which Howie talked about with the High C program that was funded through that was announced fairly early on, and most of the funding, unfortunately, has been taken up, but fortunately, we have lots of learnings from it. So the work that HSC is doing with the High C, we've got lots of case studies on innovative ideas. And then our federal lands initiative. So we've put funding together to support the transfer of surplus federal lands and buildings to eligible proponents. So what'll happen is there's a call to ask for people to apply for the lands, and they'll get it either at a discounted rate or at no cost, depending on the criteria that they've met. And we're looking for pretty long-term affordability, 25 years at least on these types of projects. And of course, Vesna has gone into the mortgage loan insurance. So speaking of criteria, all of the NHS programs, funding programs, have prioritization criteria that really covers, this slide sort of covers a lot of the programs. And I want to highlight criteria that are minimums that make you eligible for the programs, but we look usually to exceed to make your project more likely to be approved. So I've talked about the intended residents in this, the vulnerable populations. Each of the programs we're looking at 5+ affordable units or beds. Of course, they have to be financially viable. From a social inclusion perspective, we look at a few things like access to transit and amenities. And now I know for a lot of communities, they don't necessarily have transit. So we're going to, in that case, it's understood. And they look at walkability and access to amenities. The affordability depends on the program. So there's a different degree and duration. I talked about the Federal Lands Initiative having 25 years. It's different criteria for a couple of our other programs. And then, of course, the energy efficiency and accessibility features are built in as criteria for each program. So let's look at the seed funding program. So that can provide contributions or loans to assist with the planning costs of building a new affordable housing project. Now, of course, there's two streams. There's new construction, which provides up to $150,000 of funding contribution and up to $350,000 in an interest-free loan. I'm just going to mention the preservation. It's up to $50,000 in funding contribution. It is for related to activities related to the sustainability of existing community housing projects. So if they're looking at doing an age-friendly audit or an energy audit. But again, let's focus on the new construction. So it's open to anyone interested in creating affordable housing, and almost any affordable housing project of 5 or more units is eligible. When you look at the eligibility and eligible projects, this is going to be the same for seed as the National Co-Investment Funding, which I'll talk about later. So it's community housing sector, so nonprofit housing or organizations and rental co-ops, municipal and provincial governments, Indigenous governments, private entrepreneurs, builders, and developers. From an eligible project perspective, we're looking at anything from shelters and transitional housing to conversion projects to Indigenous to mixed-use markets. So it's a pretty broad group of projects that it's eligible for. And this is the type. These are the type of activities that you can do. So, anything from business plans to site surveys, design, site drawings, and specifications. What I do want to mention is that you get your seed application in as soon as possible in the building process, because you can only access the funds once you're approved. So things that you've done prior to approval won't be covered. So it's everything from approval forward that gets covered. So with seed, they'll accept and review applications on a continuous basis. The turnaround time is about 6 to 8 weeks. An example of a project that received seed funding is one by Indwell. So those who are on an earlier webinar will recognize Indwell. And this is the Harvey Woods project out of Woodstock, Ontario. It's a former factory building that was closed in 1990 and is reopened in 2015 as a 54-unit residence. Now they've since added on to this, but this was the initial project that got the seed funding. And it is affordable housing to low-income residents living with mental health or other disabilities who require a little bit of support. The interesting thing about this project is that they did a great conversion on it. It's really a nice-looking building. They have a community sort of kitchen in the middle that's separated from the units, and it's rented out sometimes to the community for events to be able to generate some income. On the addition piece that they put on this, there's offices, again, adding more income to the project. But the folks at Indwell basically said that the seed funding was critical at the early stages, and it was really the catalyst to help them develop the project. So then we have our rental construction finance initiative. So it's a rental housing supply initiative that was created to encourage the construction of rental housing across Canada by financing projects in area where there's demonstrated need for additional supply. Now, one thing I will say about this project is they're really looking for standard rental apartments. It's not for student housing. It's not for retirement housing. I know that Vesna mentioned about the mortgage loan insurance. There are some products available there, but really is for rental housing solutions. Now, you can fund seniors housing through this. So that's something to consider, and I'll talk about a project example on that later. But some of the benefits of this are that they help borrowers during the riskiest phases of product development of rental apartments, so construction through stabilization. The minimum loan is $1 million and the maximum of up to 100% loan to cost. Other benefits include it has financing features not available in the private market, such as fixed rate construction stabilization loans, mortgage loan insurance from the onset, and that can be up to a 50-year amortization. Now, we do require that it remains affordable for 10 years from the first occupancy of the project, but it's a great way to stimulate rental housing. It provides incentives for projects that are going to contribute to positive social outcomes. So one example of this is out in Welland, Ontario. It's Old Oak Place, which is a 4-story building that'll provide safe and affordable homes to 50 families. All of the units have rent below 30% of median household income in the area, and 10% of the units are accessible. And it's opening next month. Now, here's an example of a seniors housing that was funded under Rcfi. Now, the seniors do not have supports. This is for independent living, but it's a 16-unit building. It was done in with the Town of Tillsonburg Nonprofit Housing Corporation, and all units will be at affordable rates with rents lower than 30% of the median family income. It's designed to reduce energy use and greenhouse gases of 32% relative to the National Energy Building Code. All units are going to be affordable for 25 years, and all of the units are accessible, and that's easy because they're all on the main floor. 13 of the 16 units are being adaptable. And now to our flagship fund, the National Housing Co-Investment Fund. It provides low-cost loans and financial contributions to attract partnerships and investments. And of course, it's to help people in the greatest need. We've talked about that audience: women, children fleeing family violence, seniors, Indigenous people, persons with disabilities. So it's an 8.5. There's $8.5 billion in available low-cost repayable loans, and 4.52 through capital contributions. We're looking for affordability of at least 20 years. The projects, as I said, are similar to the seed funding program. So we're looking at mixed use market, new construction for multi-unit housing, shelters, transitional supportive housing. One thing I do want to mention is that FCM has announced a sustainable affordable housing program that is complementary to this and also to some of the seed funding pieces. And I can provide information about that offline later on. One example of that in Simcoe County is the Building Hope project. And it is, of course, in partnership with the City of Aurelia and the County of Simcoe. And it's a project by the Lighthouse Soup Kitchen and Shelter, and it provides a range of housing as well as emergency food and shelter, primary care, mental health and addiction services for people who are experiencing a housing crisis. So there's 2 buildings, one with 20 self-contained bachelor supportive housing units, and building 2 will have 18 rooms and it'll have 40 shelter beds. Their buildings are hoping to achieve a 25% reduction in energy consumption. And all 48 units will be designed for accessibility. So if you want more information about our funding programs, there is a website called placetocallhome.ca. And there's my information if you want to reach out to me after the conference offline.
If anyone has questions for any of our presenters this morning, then feel free to bring those in. I had a few questions just while Vesna and Arlene were speaking. So Vesna, when you were talking about CMHC insurance for new construction, I think you said that the mortgage loan insurance would be willing to look at up to 95% loan to cost. I just was curious as to what the criteria were to get to that threshold, because obviously when people are looking at building affordable housing, you do need to look at higher loan to cost ratios in most cases.
Right. This is one of the advantages of insuring a loan and having it affordable, having the project set as affordable, because exactly of that higher loan to cost. So it is based on the cost to construct. We will look at the the reports, the builder projected cost, projected building cost as per the cost surveyor report or appraisal, and then we take it from there.
Okay.
Now, sometimes what happens is that the debt coverage ratio requirement of 1.1 limits the loan amount before they can reach 95% loan to cost, but that depends on the on the details of the project. And
Okay.
95% loan to cost, as I said, sometimes can translate into over 100% loan to value, and we're still okay with that.
Yes. Yeah. You had mentioned the interest rate benefit through CMHC. Could you reiterate that? And does it, presumably it does give you access to a wider pool of lenders than you would otherwise have without it?
Well, the insured financing, you have to be an approved lender to be able to have insured financing offered to your borrowers. So not every lender is approved lender, but a lot of them, majority of them in Canada are. The list of our approved lenders is on our website. You can just do the search by putting the approved lender in the search engine. So every approved lender has access to provide the insured mortgage loan. The lower interest rates do come with it. We don't set interest rates at CMHC, it's the lender that sets them, but on average right now, let's say seeing what's coming in, depending on a 5-year term or 10-year term, the rates are slightly different, but generally speaking, they are below 2%. Uninsured product, well below 2.
Okay.
And on conventional uninsured, that's close to 3 now, 2.5 to 3.
Thank you. So we do have some questions been coming in regarding rapid housing. I presume that's RHI's rapid housing initiative. How far along in the process can you get while you await approval? And Arlene's going to look into that. And then purchase of land in place. Can an organisation look to begin the ordering of modular units if they may proceed even if RHI is refused? Also, any timeline on the announcement?
Again, if I can get the contact information, I'll get that information. There's a separate team that's looking after the RHI. And if you want to send me your email, I'd be happy to get back to you.
Okay, so perhaps if you could do that in the it won't go to everyone. It will come if you answer into the Q&A box. It'll just go into the private box for your email, and then Arlene will have access to it. Question from Jay. Fallis, what does an NGO require to qualify for larger loans? Is there a standard equation used, or is it more situational, or experience of an NGO as a requirement?
What I can say is, so I've talked about sort of the minimum requirements. And then there's that slide in terms of prioritization. We do also look for partnerships. So if an NGO doesn't have the expertise, in housing development, and I mean, it's hard for people to do that, just bring that person on your team. Work with a group that does this. We are looking for partnerships anyway. So that's kind of what we look for. And I do have a checklist of the types of steps you could go through to do that. So Jay, I could probably send that to you offline as well.
Thanks, Arlene. And can you see there's another question?
About the experience?
It says, it's from Sharon. I heard the total funding available for co-investment. What does CMHC have for funding of Rcfi? How much is left in these programs?
Oh, I can't tell you exactly what is left in the programs, but I will tell you they're all fairly competitive. There is still funding available in both programs. With Rcfi, it is there's a bigger wait list at this point. It's been very well received. In fact, from when we first launched it, we had more money added to it. I don't know, I can't tell you what's going to happen going forward, but we are still accepting applications on both. I think that the Rcfi, there's a bit of a longer queue, as it were.
Okay. Going back, Vesna, to the mortgage insurance, have you found that developers have been able to take advantage of it in general terms to build affordable housing, or is it still a challenge really in the absence of being able to access government grants? I think you're on mute, Vesna.
Yes, I was. Such a typical phrase for 2020 and looks like 2021. You're on mute. So yes, sorry, I was going to say, of course, that municipal and regional support, government support, is extremely important to have when speaking affordable, and that is something that opens the door to the wide variety of programs and products with CMHC, including what Arlene was talking, the NHS programs. But in the absence of that, government or regional support, we still do see quite a few of the affordable housing projects come our way under the standard mortgage loan insurance affordable product. And that's under the option A that I was talking to, where they have to just meet the affordability requirement for the flex product, as I said, as outlined in the presentation. It's also on our website. So we do see quite a few of them coming through, and it is something that developers definitely can take advantage of. For those products that I just mentioned, standard mortgage loan insured affordable product, they still have to go through the lender and get the lender on board before they can come to CMHC for it.
Okay. And I had one more question or clarification about the insurance as well. When you were talking about refinancing, so I don't know if there is anyone on the call today who's already has an affordable housing or a rental housing project, and they're looking at possibly refinancing. I noted you said something about eliminating equity takeout, and I caught that you refinance for the purpose of capital repairs. Could you also use it for the purpose of building affordable housing elsewhere? Yes,
of course. That is the restriction on refinancing. We're still looking to promote the bringing new affordable or even rental, just in general, rental stock onto the market. So definitely encouraging use of the funds to construct new or purchase an existing project rental. It has to be rentals. So the whole purpose of that restriction is to make sure that if the project is refinanced, the funds are being used further to help the rental housing stock in Canada, not equity takeout just for other purposes that are not linked to affordability or rental housing.
Okay. Howie, circling back to your overview of the high C, you talked about you started to talk about social bonds in the context, I think, of the regeneration and conversion uses of financing. Could you just talk a bit more about that, or elaborate on it, and how is it different to what Housekeeping is doing now?
Ordinarily, when bondholders are investing, they basically just look at the metrics and whatnot. But in the last while, especially in the last year, there's been a heightened sort of demand for social impact bonds, primarily generated by a number of the life co companies and their boards, basically saying they want to have much more mission-driven investments. Sure, they want a proper return on their investment, but they also want to have a lot of the softer social impact attributes. And Affordable Housing Canada is a logical choice for those types of investments, because we hit all four corners of those kind of needs. The challenge is that when you issue a bond, you're a public company, it's tough to actually show how it would impact the social good, because you have to talk about the projects that the funds are being used for. In our case, it's 100% affordable housing. It's all borrowed by nonprofits, so it's a very easy way of showing the social impact of it. And as I said, if you go on our website, we've just announced that in the last couple of weeks, we're seeking to have all our bonds that we issue in the capital markets to be social bonds, so that and we report on it on an annual basis to our bondholders. So it basically, full circle, the notion of social bonds in affordable housing makes a lot of sense, and it basically there's a huge demand for it now, and so I think it just gives an added, I think, luster to what we're trying to do here in terms of raising money for the affordable housing in Canada.
Thanks. So I'm not seeing any more questions that have come in, but lots of things to take in this morning, I'm sure, and really appreciate Howie, Vesna and Arlene giving their time to share with us this morning. I think Brittany has shared in the questions box a link. If you did have further questions, we would try and circle back to you on those. So thank you once again to all our presenters this morning. Thank you everyone who has tuned in to listen to this important topic. And we will be putting a recording of this morning's session on our website, which again, Brittany has put the link up as to where you can go. It's simcoe.ca, and if you find the social housing pages, you will find your way to the link, I'm sure. We will be looking to host another virtual forum probably towards the end of March, so look out for the invitations for that. And thanks for joining us, and have a great rest of Thursday. I can see some blue sky where I am, so that's nice. Bye for now, everyone.
Bye, thank you.